In the volatile realm of economic indicators, the latest job numbers for November have thrown both analysts and markets into a state of uncertainty. The seemingly positive news of close to 200,000 jobs added is overshadowed by a paradoxical reaction in the markets. Unemployment rates have dipped from 3.9% to 3.7%, signaling a tight labor market with only around 6.3 million unemployed persons. Private payrolls saw a commendable increase of approximately 150,000, while the manufacturing sector contributed to the resilience with a boost of 28,000 in payrolls. The participation rate also saw a slight uptick, reaching 62.8%. However, the paradox deepens when we observe the market reaction. Traditionally, strong employment numbers would be hailed as a positive sign for the economy, yet the pre-market trends indicate a contrary sentiment. The Nasdaq, S&P, and Dow Jones indices were all down, with futures showing a dip of about 30 to 40 basis points. This raises the question, why are positive job figures leading to a negative market response? The answer might lie in the nuances of the broader economic landscape. Despite high unemployment rates, the private sector appears to be robust and well-capitalized, generating strong cash flows. Consumer spending, fueled in part by credit card debt, is contributing to robust earnings and cash flows for companies. This apparent contradiction suggests a complex interplay of factors, leaving analysts grappling to decipher the true state of the economy. The bond market, often considered a bellwether for economic health, is undergoing a notable shift. Yields are pushing higher, reflecting a rebound in the bond market. The 10-year yields, in particular, have experienced a significant bounce, surging by almost 2%. This abrupt movement in yields is indicative of a market reassessment, prompting investors to recalibrate their expectations. The probability of a rate cut, which was a topic of speculation before the employment numbers release, has now taken a different trajectory. The strong employment figures have led to a decrease in the likelihood of an imminent rate cut. Markets are currently pricing in rate cuts starting in May 2024, with 5 rate cuts priced in through December 2024. This shift in expectations underscores the impact of economic data on market sentiment and the delicate balancing act of central banks in responding to evolving economic conditions. The Federal Reserve stance, as reflected in recent narratives, emphasizes the need to keep rates higher for longer to address inflation while simultaneously maintaining a strong economy. The strong job numbers may discourage the Federal Reserve from considering rate cuts, as they navigate the delicate task of taming inflation without stifling economic growth. The narrative underscores the importance of a compelling reason, such as a recession, for the Fed to entertain the possibility of rate cuts. From a technical analysis perspective, the strong economy may point towards a soft landing, a scenario where the economy transitions smoothly from a period of robust growth to a more sustainable pace. However, this optimistic outlook is tempered by the possibility of higher interest rates persisting for an extended duration. Technical indicators hint at a potential market pullback, though the magnitude is estimated to be modest, ranging from 2 to 4%. The impending December seasonality adds another layer of complexity, with historical market patterns potentially influencing the trajectory in the short term. Yet, the broader uncertainty persists, casting a shadow on the macroeconomic picture for 2024. Looking ahead, the next Federal Reserve meeting looms on the horizon. This event will be closely watched by market participants seeking insights into the central bank's policy direction in light of the recent economic developments. The juxtaposition of a strong labor market and a market seemingly skeptical of this strength sets the stage for a nuanced discussion at the Federal Reserve. The market trifecta, composed of the dollar index, crude oil prices, and 10-year yields, is exerting its influence on market dynamics. The dollar index has seen a 1.5% increase, reflecting shifting global currency dynamics. Crude oil prices, a crucial indicator of economic vitality, are up by about 2%, hinting at both demand-side pressures and geopolitical factors. Meanwhile, The upward movement in 10-year yield signifies a recalibration of risk appetites and expectations for future economic conditions. In conclusion, the landscape painted by the latest employment numbers is a tapestry of contradictions and uncertainties. The positive job figures should, in theory, be a cause for celebration, but the market's reaction tells a different story. The bond market, rate cut probabilities, and the Federal Reserve's narrative all contribute to a complex web of factors shaping the current economic discourse. As analysts and investors grapple with the implications, the upcoming Federal Reserve meeting becomes a pivotal event, offering insights into the central bank's response to a resilient labor market and a market that appears hesitant to embrace the good news. The market trifecta, with its intertwined components, further adds layers of complexity, underscoring the intricate dance of economic forces at play. As we navigate the uncertainties of the coming months, the only certainty is the need for a keen eye on evolving economic indicators and a cautious approach to interpreting the intricate tapestry of the financial markets. Disclaimer: the information is for general purposes. Viewers should conduct research and consult professionals for financial decisions. Please consider liking, subscribing, and sharing with friends to support our content.